Hello, everybody. It's a pleasure to be with you today. My name is Sajid, and I'm currently working with Habib Bank AG Zurich as a Deputy CRO. First of all, thanks to Risk Awareness Week conference organizers for inviting me to conduct this workshop, which is acting rationally in an irrational market. I'm very passionate about wealth management and investment risk, so I follow them very closely. This is a brief introduction about myself. You can read about it. This is a very important disclaimer. Um, so, uh, so today we are going to look at quite a few interesting topics in our today's workshop. All these topics and concepts are fairly big topics and easily could take a separate full workshop on them individually. So bear with me, and we are going to go fairly rapidly through these and not in a huge amount of depth, given the limited time available to us. But I hope, nevertheless, you will find some of these ideas a bit challenging, stimulating, and certainly interesting. So today we'll start with some basics, and we will briefly look into traditional investments and traditional investment strategies. We will then move to details of rational investing, and we'll discuss the efficient market hypothesis. After that, we will discuss about some pitfalls of traditional and rational investing and efficient market hypothesis. I will present you a case study to understand it in details. The tools presented in a case study will also help you to evaluate your investment decisions. Then we will quickly touch upon the non-rational or behavioral investing and how it is contrary to rational investing. Last but not the least, I am going to give you a very important and secret investment strategy, which I believe could really help you to create huge amount of wealth if you adopt the idea in your thought process while working towards your wealth creation goals. So it's going to be very interesting workshop, but you have to stay with me till the last. I promise you will not regret, and the time you are investing here will not be wasted. So I will quickly touch upon the basic and traditional investment types. In financial world, we call them asset classes. So an asset class refers to a group of assets with similar investment characteristics. Within an asset class, the financial security exhibits similar risk and return patterns. You can see that I have provided some example of instruments or securities in these asset classes and also their popular constituents. For example, cash usually meant for readily available liquidity, which provides the purchasing power to the investor. In the bottom part of the slide, you can see some traditional investment strategies. In short, we can say that these investment strategies help investors choose where and how to invest as per their risk appetite. For example, their expected return, available funds, long-term or short-term holdings, retirement planning, choice of industry, sector, etc. So risk appetite of an investor defines their investment plans, the objectives and goals they want to achieve. I will not go into the details of each and every strategy mentioned here because this requires separate session for each of them, and this is not the purpose of our workshop. However, we only need some basic understanding of these so we can understand the what the pitfalls of these investment strategies are. So you can see there are 7 different types of investment strategies. You can understand some of them as their name suggests. For example, passive and active strategies are basically about the frequency of